Hello, everyone. Good evening. Can I get a mic check real quick before we get started? Hello, Denisha. Hello, Christopher. Awesome. What's going on, CRYY? How are you doing, brother? Alrighty, looking forward to getting started. Hope everyone's had a good weekend. Got an interesting week here ahead of us. Just a couple things to keep in mind going into this week. We do have non-farm payroll on Friday. So personally, I will just be interested in Monday, Tuesday, Wednesday. One thing I do want to note about Monday's trading session is we have had a large range Friday, so I will be very patient on the AM session come Monday. So I will more than likely reserve my trading to the PM session. So with that being said, we have an on-farm payroll. We also have the opening of the quarterly candle. So we've just closed last quarter, and we've just recently opened another one. So I am expecting this week to not be the cleanest delivery. There's several factors, as we said, non-farm payroll. It's also Passover week, or Easter, as many of you know it. So that is a week that a lot of big money, big funds prefer to sit on the sidelines and not assume any risk. So there's several factors that point to this week not being the best in terms of price action and quick delivery to objectives. So just some things to keep in mind. And then, as I've said, we do have the opening of the quarterly candle. So as we know, the opening of all candles, we typically see some sort of accumulation, manipulation, and typically those two phases of the candle lead to unclean price action that is usually not favorable. So just wanted to throw that out there for you guys. Make sure we're nimble intraday and don't have too much expectations for this coming week. So with that being said, let's get right into it. So looking at the dollar index here on a monthly chart now, the month of March has closed and it was a bearish week or bearish month. This previous week was bearish. So looking at the open, we traded higher into this volume imbalance. Oh, and one more thing I did want to bring up is that we do have a breakdown of the COT reports and a typed up analysis that we have received from the COT. So we'll be sure to add that to the Telegram chat so that you guys can read how we're internalizing the COT reports to use it as an additional confluence to what we're seeing here in the technicals. So looking at the monthly chart, we've rejected this volume imbalance here pretty hard, and we have traded lower. So looking at where we are now at market price, we do have sell side here, and we do have an inefficiency below the 100.9 level. So we do have quite a bit of an inefficiency here that I will favor expansion into for this coming month. So that's all I'm seeing here on a monthly, dropping down into a weekly. So down close week last week, we rejected several premium arrays that we'll see here on a daily. And then for those of you guys that were in the Telegram channel, we did update you guys as to what we are seeing and the shifts in order flow and state of delivery for the dollar that then led us to expect higher prices on indexes as well as foreign currency. So looking here at the weekly chart, we did get an expansion lower. We were looking at this fair value gap here this previous week, and we noted that we did close above it. The previous week we opened, we traded down through it and closed, and we delivered down into this discount fair value gap below market price where we have not had a closure below, and I am expecting lower prices as long as we do see several things that I will outline in a daily chart. So pretty much bearish month for the month of March. I will expect continuation into the month of April, assuming bearish order flow continues, and I'll show you guys what it is I'll be looking for here in the lower time frames. So we did get a closure below this key fair value gap here that we were looking for, that if we were to go bullish this previous week, we would have found support here and rallied higher, which we did not. So we did have risk on this past week. Dropping down into a daily chart, that's all I'm seeing for the weekly. Okay. So in these previous weeks, we saw a rejection of this bearish breaker. We see price traded at the high end of that, which is permissible, into the fair value gap, and then we immediately rejected that lower. Here we had the opening of this daily candle. We traded higher into the bearish order block, and then we rejected that strongly, seeking discount, relative equal lows, fair value gap, and a bullish order block. So now this is where my analysis is a bit conflicted here on a daily chart. Reason being is that now we have delivered to a discount and we are sitting inside of several discount arrays. So I will demand more information. However, I'm not going to leave you all with a 50-50. I'm going to tell you guys what I'll be expecting and what it is I'll be looking for with whatever price shows us into this coming week. So we have delivered down to the opening price of this bullish order block. So we do see price is finding support inside of this level. Also looking at the fair value gap on the daily chart, we've delivered to the low end of that, but we have not been able to accelerate and close down below it. One other confluence for this price level that I was monitoring this previous week was the consequent encroachment of this wick. So that'll be the 102.206 level. Okay, so the dotted line is the consequent encroachment of the wick. So we do see that we have had a reluctance for price to close below key levels, being the opening of this bullish order block, as well as the consequent encroachment of the daily wick right here. So we have seen support inside of these discount levels. So that's something that is leading to a conflicted analysis in the dollar. We have been seeing bearish order flow. I do not like to call tops or bottoms in the market. I like trading the order flow we're seeing. So we did see that the market opened on Monday. And as I shared with you all last week, if we were to go higher, we would need to find support inside of this SIBI, sell side imbalance, buy side inefficiency. And we did not. We traded it down through it, and then we left a liquidity void here. Liquidity void because there's been no trading here. We closed at this candle, opened here. So this is inefficient. The algorithm has no data for these price levels, so the market will want to reach into it. So as we see here, price tried to reach into it once more, and then it failed, indicating bearish order flow. So what do we expect? Price is going to want to seek discount. What are discount levels? Well, we have a consequent encroachment of the wick. We have the opening of the bullish order block, which price delivered down into, but then we failed to accelerate down below. So going into this new week, I am still favoring lower prices for the dollar, given that we are seeing bearish order flow. The interest rates have been bearish, and then we'll cover interest rates after this, of course. So we are seeing several confluences for lower prices on dollar. What would negate that and switch my bias to bullish would be if, let me mark out this SIBI. Again, sell side imbalance, buy side inefficiency. So in red, we have this SIBI, and we have this liquidity void in here at the 102.834. And then the low end of that would be the 102.764. So inside of these key levels, I will be monitoring order flow going into this coming week. So if we trade up into these levels and then get heavy, that's what I would prefer to see. That would be in line with my bias, which is lower prices, and then we would attack the relative equal lows we have here. However, what would negate my bearish bias is if we trade above these key levels, the SIBI and the volume imbalance or liquidity void. If we trade above it and find support, then we could rally up into the SIBIs, the inefficiencies in a premium. So those are the two things I'm looking for and what would negate or confirm my bias. Price, if we are to remain bearish, should not rally above these key levels. And if we do rally through them, it could signal a deeper retracement. So then I would take my attention to the premium arrays above market price, being the buy side here, the fair value gaps there. But assuming we trade up into these key levels and reject, then we have the relative equal lows here. And we have a volume imbalance that price has not traded down into yet that I would then favor delivery down into. So that's what I'm seeing with dollar and what I will be looking for into this coming week to determine risk on, risk off. And then we will now look at the interest rates to even get a more precise feel of risk on, risk off. Okay, so looking at the bond market, let's start on a weekly chart. So a few things I wanted to point out here on the weekly. So just looking back here a few weeks, we traded down into this bullish order block. If we were going to attack these relative equal lows here, we should have accelerated below this key level, which we did not. So we found support inside of the wick of this bullish order block, which is the sensitive price level on an order block when we do have a wick. So price traded into this level and immediately reacted bullishly off it. And then we have traded higher. So immediately our attention goes to the relative equal highs. That's what we're trained to look at and target as a bullseye. So I will expect delivery into the buy side liquidity for several factors. One, we are seeing bullish order flow on the bonds, and we also are seeing price find support inside of this volume imbalance here. So price has been unable to get through that key level, and then we have found support inside of that. So that's all I'm seeing here on a weekly chart. Dropping down into a daily now, we still see those relative equal highs, and then we could even really extend that here. Why is that? Retail seeing that as resistance, and even large fund traders, they do trade with these types of strategies. So they'll look at a daily, see where price is pulled away from, and then they will look to short it, and they're going to trust their stops being above these highs. So that's why the algorithm is coded to target those key levels, because the smart money traders that we refer to, they're not looking to capitalize on retail risk mistakes. There's a food chain to this game that we call the financial markets, and they are looking to target these large fund traders that are managing millions and billions, and these are their trading styles, putting stops above key highs, key lows, and that's why we see the market deliver to these levels consistently, and that is the reason for that. So looking here at the daily chart, we have a city in here, and I took our attention to this here a few weeks ago. Price is extremely bullish on the interest rates, so the 122.30. So we see here price was unable to trade below the consequent encroachment of this fair value gap, indicating price is extremely bullish. And then we have seen that strength into the coming weeks. We also have a breakaway fair value gap here. Breakaway gap is a gap that has been unable to be delivered to, which is another bullish signature. And we have this volume imbalance transposed from the weekly down to the daily. And then for those of you guys that are in the Telegram channel, which I would recommend you guys join, it's free. My associate colleague, Tommy, did a really nice educational thread on how to use volume imbalances, not only as entries or targets, but also as a way to measure order flow and determine where the market is likely to go by basing our analysis off several measurements of key PD arrays. So applying that same logic that my colleague discussed in the chat, we see that same phenomena playing out here. Volume imbalance, price traded down into it, bodies respected it, traded down into it once more, rejected, traded down once more, and rejected at higher. So we are finding support inside of this key level and unable to close below it. So that is a bullish signature to me. And then we have seen price trade higher off that level. So I will expect delivery into the buy side liquidity above these highs. What would negate that for me is if we see price trade into this bullish order block, bearish order block, and then reject lower. So the 132.08 level, if we trade up into that and then get heavy, that would not bode well for bullishness. But we did close above this civvy, this fair value gap in here. We did get a closure above it. So I will expect continuation into the buy side liquidity as long as we accelerate through these key premium levels. One thing that was a cause for concern for bullishness on the bonds last week was the fact that we see the bodies are nicely respecting this fair value gap here, but then we have also seen that price is also respecting this key level here. So price should accelerate through the bearish order block and the fair value gap if we are to see these highs taken out. And then that would also lead to a bearish dollar. So risk on, meaning indexes and foreign currency higher. So for our euro, British pound traders, what I said in the dollar, reverse that, and that's exactly what we're seeing for the euro and the British pound. But if you do want me to take a look at that, I would be more than happy to. So that's what we're seeing for bonds. So the bonds will confirm what the dollar does, and then the dollar tells us as traders whether we trade forex, indexes, whatever that may be, whether we are risk on or risk off. So we're able to use these in our analysis to determine where the market we trade is likely to go. As I've said, I personally specialize in indexes, and I invest in a wide array of assets, whether that's commodities, gold, silver, different things. I trade derivatives of those assets as well. So I do use the risk on, risk off, not only for indexes, as I specialize in index trading, I use it for a wide array of assets to determine where the market is likely to go. So now going into the ES market, let's start on a weekly, and let's go to the continuous contract because there's some data missing here on the current month contract that I do want to take our attention to. Okay. So looking at a weekly chart here for the ES, we have buy side liquidity in the form of these clean highs here. And this is the draw I am expecting for price. Originally, we were expecting delivery below these lows, but as I've said, the market is a living, breathing organism, so we do have to adjust to what price is showing us. If price is showing bullish order flow, it would be foolish to try to insist that we're right and go lower. So the reason I was able to adjust my bias and my stance on the ES is exactly what I showed you guys in the dollar. So looking at the dollar just real quick, several bearish signatures here in the dollar index. Looking at this fair value gap, we see that we then traded below it. So as I said, if we were to remain bullish, we should find support and then rally. Instead, we traded below it, and then we used it as resistance. Notice how the bodies respected these levels perfectly, and we rejected the liquidity void twice. So bearish order flow on indexes means risk on, so that will allow the index markets to rally much easier. And then we did see that going into the week. So what I wanted to share here on a weekly chart is this buy side liquidity, these relative equal highs, is my draw into this next coming week. That's where I'm expecting the market to draw into. Now looking at the official front month contract that we're using, here you see how here we can't see that those relative equal highs in the same way. That's why I wanted to show the continuous contract. But we still do have this buy side liquidity pool here that I am expecting the market to draw into. Looking at the volume imbalance in here, as my associate was pointing out ahead of this meeting, same thing that we were just covering, how you can use volume imbalances or really any PD array to gauge and measure order flow. So here we see price traded into these key levels once, unable to get a closure below it. Traded out into it again. We were unable to get acceleration on the downside, and we did find support. So we have seen price traded through this bearish order block I took our attention to last week. So the previous week, we had a closure right at this key level. So if we were to continue lower, price should have wasted no time and immediately accelerated on the downside to attack these key levels. Instead, we traded through this bearish order block, indicating that price is now, or the market is now in a buy program, seeking premium objectives. And we saw that very clearly last week. So looking at the volume imbalance, we found support, we rallied, traded through a key premium level, indicating price is now bullish and price will now seek premium objectives. So that's all I'm seeing here on a weekly chart. Perfect. Okay, dropping down into a daily. Take this off. Okay, so we have been seeing bullish order flow here on a daily, and then we have confirmation with a SMT. We see that the Dow took out these lows the consolidation that we had during the holiday season, we see that the Dow actually took out those lows and the ES and the NASDAQ were actually unable to. So we see that clear SMT here, which was further confirmation for a rally. I was not expecting higher prices until we displaced higher and failed to close below these key levels. So this is what I was looking at early last week that allowed me to shift my bias and expect higher prices and delivery into a premium. So we have a volume imbalance here with these two black lines from the March 1st and February 28th. So volume imbalance, separation between the bodies. We see that the bodies, the candles from this previous week respected price beautifully. And overall, looking at the higher time frames, it was clean delivery, but looking in the lower time frames, it was overall a sloppy week. And this is because the dollar was rallying at times when the indexes were rallying. So we did see several high resistance liquidity runs. And another thing is a lot of the moves actually delivered during the London European session. And then as we know, or if you don't know for your notebooks, whenever we do have a huge move in the London session, and then people usually ask the following question, all right, well, what's a big move? How do you know what a big move is? The way to determine that is, has London reached a premium or objectives on a higher time frame? So if we do see London deliver to objectives that we would expect typically happening in the New York AM or PM session, it's usually advisable to let the AM session go, just use it to collect intel to then come back and execute inside of the PM session. So it was a pretty sloppy week inside the lower time frames if you were trying to intraday trade, but it was a textbook week on the higher time frame. Monday we had our accumulation, Tuesday manipulation lower, making the low of the week, and then price rallied into the close. So this week was pretty much just a straight shot higher. Anyone that was trying to short got punished because the market was just continuously grinding higher, seeking premium. It was not reversing, it wasn't looking to go lower. And this is a buy program, and it wanted to get to these objectives. So whenever we see the market continuously spooling higher, you really want to try to avoid trying to call a top and short and short and short, because if you would have tried to do that this week, that would have made for a very difficult trading week because the market was clearly screaming higher and you don't want to go against that order flow. So looking here, the early indications to me this week on Wednesday was the fact that we were unable to close below this volume imbalance. Price then traded aggressively higher through this fair value gap and into the buy side. So this was my indication that the market is seeking premium. So my first target then became this buy side liquidity here, and then this buy side liquidity pool here. And then my last target for Friday was this SIBI in here, this sell side imbalance, buy side inefficiency. And then if you see here with the line, we nailed the consequent encroachment beautifully. So overall, in the higher time frames, market did deliver to logical levels. Just intraday, it was a pretty sloppy week overall. Okay, so that's kind of what we saw, or that's exactly what we saw this previous week. Now going into this week using that intel, what will I be expecting going into this coming week? So we have a bullish breaker that I would not want to see price get below. If we do get below the breaker, maybe on a wick basis, we could be touching into this bullish order block in here. However, we should not get below this fair value gap in here if we are to remain bullish, in my opinion. Why? Because we have a breaker, we have a fair value gap in here, and the order block wick. So I would not want to see price get below these levels if we are to remain bullish. However, this will depend on how the dollar trades. Dollar should remain soft, giving us that risk on bias, and then we should see acceleration into the upside for the index markets. Also looking at the NASDAQ real quick. NASDAQ has been extremely bullish and it's already taken out these highs. So I'm thinking that the ES will want to catch up and also deliver higher to these premium objectives. And then as I've shared with you all in these previous weeks, why would the NASDAQ be the relative strength leader? How could we have determined that? Well, if you look at the interest rate markets, interest rates have been extremely bearish. So with interest rates falling so hard, that's going to help tech companies because tech companies operate with higher debt margins than any other business model. So that will allow the tech companies to rally much more. And then if you look at the S&P, it does have quite a few financials in it. Your Goldman Sachs, your JP Morgan, your Bank of America. Banks like higher interest rates. Why? It's pretty logical. Every transaction or whenever you go to do business with the bank, they're able to have higher profit margins through the higher interest rates. So higher interest rates or lower interest rates will typically benefit tech companies, which is the NASDAQ, and will typically not help the S&P rally as much. So that's how you can even use the index or the interest rates to help you determine which is going to be the relative strength leader for the index markets. Absolutely, Denisha. Thank you for sharing your time here with us. Always a pleasure to have you. So yes, looking at the NASDAQ here, we have rallied higher. Now let's look at the continuous contract because there's a lot of missing data to the left. Okay, so price has traded into this order block in here. I will want to see how price trades inside of that key level. I will favor acceleration on the upside. So looking at the NASDAQ, we now have a bullish order block in here. These two consecutive down close candles. So I will want to see price stay above this key level if we are to rally. And then we do have an inefficiency above market price that I will favor price delivering to. So we have this SIBI inefficiency and we have buy side liquidity above this high. So that's what I'll be favoring here on the upside for the NASDAQ as long as this bullish order block remains as support. And then for the ES, let's look at the continuous contract once more. So we have that buy side above here. So assuming we get through that and then we accelerate with speed, we do have another buy side liquidity pool above market price here. That would be my second objective. And then assuming we get a lot of acceleration on the upside, we also have a fair value gap in here that price could want to reach into. However, that does depend on the dollar and whether or not we find support inside of this breaker. And that would line up with the NASDAQ finding support inside of its order block. So with that being said, that's what I'm seeing for the trio that I look at. So I will now take a look at the Euro. Hassam, yeah, absolutely, Hassam. I'll take a look at the Euro for you, absolutely. I know we have quite a few Euro traders in the house. Okay, so really nothing here on a weekly chart. Okay, looking at the daily for the Euro, we did have an SMT down here that was an indication of higher prices. Let me show you guys what that was. So here the Euro failed to make a lower low, whereas the British pound did. So that's indication that we are likely to see a reversal because we have also seen multiple shallow runs of the lows. So whenever you see multiple shallow runs, that is engineering sell side liquidity, which will then likely see a rally in the opposing direction because sell side's been purged multiple times. So then we will expect the price to rally in the opposite direction. And then the SMT was also confirmation for higher prices. So looking here at the Euro now, we have dropped into this bullish order block and we found support and rallied higher. So we are seeing order flow is bullish on the Euro. Okay, so we are seeing support inside the order block and fair value gaps, and then we have traded higher. So we now have relative equal highs here and buy side. So I'll go ahead and do the Euro and British pound analysis together since they're so correlated. So we have relative equal highs here on the Euro that I sent you, that I sent to the Telegram channel as a update. So this is my drawn liquidity for Euro. We did see price find support inside the volume imbalance, rallied higher, found support here inside of this volume imbalance and propulsion block. Why would this be a propulsion block here? Because it's an order block nested inside of another order block. So we'll expect the sensitive levels to be the upper wick and the mean threshold. So we see here Price traded down into the wick and then immediately rallied higher and was unable to trade lower. And that's what we would expect with a propulsion block. So the drawn liquidity for me for the euro will be this buy side liquidity here, as long as we stay above these down close candles, as we should seeing bullish order flow, down close candles supporting price. So we should continue seeing that into this coming week if we are going to see delivery above these relative equal highs. So that's what I'm seeing here for forex. So now going right into the ES, I was actually going to do so I'm going to start here with a teaching on SMT, how I use it, what insights it gives me as a trader. So let's look at the ES, the continuous contract, and I'll share with you guys how I actually used it this previous year to determine quarterly shifts and longer term daily bias. So looking at these highs here, for some background, in the spring months, we typically expect a high to form. That's in line with the seasonality for the index markets. So we typically expect some kind of topping formation to set up inside of the spring months. And in the fall months, we typically expect some kind of significant low to form to then rally into the last of the year. So looking at the seasonality, we are already expecting a high to form during this time as we're in the March-April time. So we are expecting some kind of significant high to form. So how could we have confirmed that this was indeed the key high and then to expect shorts into the latter part of the year? Well, looking at these relative equal highs here, price traded higher above this buy side, displaced lower, attacked discount, traded higher into premium once more, and then attacked discount again. So we see relative equal highs here after trading below key sell side liquidity. So then we traded higher into the buy side, the relative equal highs here. So as I've said with the seasonality, we're already looking for some kind of high or key high to form to expect continuation lower into the following months. So looking here at the Dow actually failed to make a higher high. So here we have these same relative equal highs, and then we had an SMT with the Dow that set up the quarterly shift for the spring months to then expect lower downside delivery. So this is the SMT here for the spring months that I use to then anticipate the quarterly shift and lower delivery into the fall months. And then, as I said, with the seasonality, what do we expect in the fall? Some kind of significant low to form, and then price to have an extended rally into the winter months and into the following spring. So then this previous spring here, or fall, okay, so for a little bit of context here, this fall, we do see that the ES was bearish all year after forming that significant high in the spring months. And then we have traded down to key levels, sell side liquidity here, external range liquidity. So then we would look for some kind of significant low to form. So external range liquidity was purged, and usually it's external to internal range liquidity. So we're already looking for higher prices because we've taken out a key low. So what's the confirmation that we are likely seeing our quarterly shift for the fall months? Well, here we see that the Dow was unable to make a lower low, whereas the ES and the NASDAQ did. So we see this SMT crack and correlation. What did this indicate to me? That the Dow was under heavy accumulation of longs. And this is shown algorithmically through an SMT. This is purely algorithmic. This is that crack and correlation. That is that indication to smart money that it's time to get to work and we are likely to expect higher prices. However, one thing to keep in mind is that SMT by itself means absolutely nothing. As I've shared with you all in these past two examples, there needs to be a greater context as to why we're seeing or why we're expecting a shift in market structure or a quarterly shift. So with all that context in mind, the SMT is simply a indication that we can use by using correlated assets to confirm what we are already seeing, making it higher probability. So now that we looked at some examples here on a daily chart, let me show you guys how I used it intraday in my trading last week. Okay, let's look at Wednesday's trading. And I used it several times this week, so I will have several examples. Okay, so this is Wednesday's trading. Okay, so we are already looking for higher prices. As I shared with you guys on the higher time frames, we saw the volume imbalance hold price above it, more specifically the bodies, and then we saw price continuously seeking premium. So now how do we use all this analysis intraday, and what further confirmations can we look for using SMT to determine that we are on the right side and that price is likely to continue rallying higher? So here inside of the New York session, we start trading at 9:30. So let me put a line on 9:30. So typically going into the New York session, London will typically make the low of the day in a trending week, and then New York will retrace to give us some kind of optimal trade entry to then get continuation. So what was my confirmation that the party was over for bears and that we were going to see continuation on the upside? Well, as I've said, the SMT by itself means nothing, but because I'm already looking for higher prices on the indexes, as that was indicated to me with the risk on in the dollar, I'm now looking for confirmation that the algorithm will give us if we know what we're looking for to solidify our bias. So here we see that the Dow actually took out this low, and we see the ES was unable to. And then we see in the afternoon session, we see continuous rallying. So this is one example of how I used it to get on side and make sure I was on the right side of order flow with several confluences. So now looking at Thursday's trading. Okay. So looking at Thursday's trading now, let's compare the ES to the Dow. And when I'm intraday trading, I'm frequently sorting through all the different indexes to get these price signatures and make sure that I am aware as to what they are doing. As I've said, they give a lot of key information. Okay, so let's look at this on a 5-minute chart. It's clear. Okay, so into the PM session for the indexes. And that is Fridays. Okay, perfect. Okay, so we had a drop in the morning session starting at 9. Starting right here at 9:30, we had a drop into the morning session, delivering to a discount. So if we are bullish, we want to see the discount offer support and rally. So what was the additional confirmation that we were going to see the rally? How did the algorithm tip its hand and make it obvious that price is likely to go higher? Okay, we see a 3 drives pattern on the ES, and then we see that one of the indexes actually failed to make a lower low. So here we see that ES made a lower low. NASDAQ made a lower low, but the Dow actually failed to. So this is our correlated index, SMT divergence. Hey, Brian, absolutely. Yes, sir. We have the meetings recorded and they're uploaded right away as soon as the stream finishes. So here we see that the Dow was unable to make a lower low. So this is our indication that price is now bullish and that we are likely to see a continuation And then we saw that in the PM session. So one more example that I used on Friday. Now let me get all three charts. Okay, so into Friday's trading session, as I said, we're already looking for higher prices. I shared what those premium objectives were on a daily. So now what lower time frame confirmation can we use to determine prices going higher? So in the SMT by itself means nothing, but we're already looking for higher prices. So here we see during our New York session, if London's making the low, we expect some kind of optimal trade entry or delivery to a discount so that smart money can accumulate at a cheap price to then ride the New York expansion. So what was our confirmation that price was indeed going higher? Well, here we see that the NASDAQ took out the lows, whereas the ES and the Dow Jones failed to. So here we have that SMT, but we even had a additional SMT to further confirm what we were looking for. So once the 9:30 bell happened, we see that, so the opening bell, we see that the ES traded lower, failed to make a lower low, but we did not see that for the NASDAQ. It did make a lower low. And the Dow made a lower low. So this shows that the ES was under heavy accumulation. So this is algorithmic signature that price is going higher, and this was confirmed by the ES failing to make a lower low, that it was going to be the relative strength leader. Another thing to use for SMT is at key times. SMT happens usually at 9:30. The window for the index markets is 5 to 9:30. That's the window you want to look for SMTs to happen. And what does it tell you? Again, as a recap, it tells you which asset is under heavy accumulation. It shows algorithmic crack and correlation. That price is likely to move where you think it's going to go, as long as you already have an underlying bias and where you expect the market to go to. You can use SMT as that additional green light by the algorithm to signal, okay, we are going to seek premium, get on board. So that was just a quick teaching that I wanted to share, simply how I use SMT. What I like to do here is simply share how I use ICT concepts and how I found my way with them as a trader. I'm by no means trying to rebrand his concepts or reteach them. I'm just simply sharing how I use these concepts in my analysis and my trading. Beautiful. Okay, so that's everything I had planned to share for this meeting. So I did actually have a question from my man Radif regarding how to determine entries with confirmation. So one thing you want to look for as ICT traders, we don't just want to enter after liquidity's taken, or, let's say we're bullish, we don't want to just see a sell side purge and then just jump in. There's several confluences you need, one of which, the most important, is draw on liquidity. Where is the market reaching? If you can't determine on a daily, 1 hour, or 15-minute where the market is likely to go, it's more than likely a gamble. Because if you don't know where the higher time frame's reaching for, you're really going to get lost on a 1-minute chart. So that's the first thing you need to know before entering, is where's the market going. And then the second one is you need to make sure order flows in your favor. So what does that look like? So let me go over a trade here I took on Friday at the closing bell. So looking here, we've already had a bullish day, and let me show what the draw on liquidity was. So I was expecting this SIBI to be delivered to, and that actually delivered in the last hour. So this was my objective for the last hour. So first tick, knowing where the market is going, draw on liquidity. This inefficiency above market price in an already bullish week. So now dropping down into the 5-minute chart, we want to see some measure of liquidity taken. And then we see the rally higher. And then we see in the lunch hour, which is the macro, that it's going to come back on the buy stops from the morning session. So we see the buy stops ran out, and then we see a displacement higher. So one could just enter on the fair value gap. But what I want to really emphasize in this specifically as it relates to how to get a entry that has high probability confirmation behind it, the key is looking at order flow. That's personally how I use it and how I avoid a lot of, false market structure shifts. And I'm able to enter in line with the market that's already predisposed to move in the direction I think it's going. So we see here, I actually just came back to my trade station for the last hour. So I started trading here at the 2:45 hour. I usually like to get myself situated at 2:45. That gives me around 15 minutes to see how the day traded, what liquidity pools or inefficiencies are we likely to deliver to, and then I'm ready to execute in that last hour macro. So just real quick here, as I've said, the AM session buy stops were purged inside of the lunch hour, and then we get what we expect, the displacement higher through a swing high, indicating a market structure shift. So now this is what I mean about order flow. It's not just simply, okay, well now we've taken out a swing high, let's buy it. You want confirmation that you're on the right side of order flow. And that means that discount arrays are supporting price. So do we see that? Yes, we see we have a fair value gap in here. Price trades into it. Body's unable to close below it, we rally. We also have a volume imbalance in here. And then as the educational thread that my colleague made, we see that the bodies are respecting that, and then we come down and we touch it once more, hit it like a brick wall and rally higher. So we're seeing order flow is now in our favor. We're seeing discount arrays support price, and we are continuously seeking premium. So we have relative equal highs here. Why was I still confident going long after we'd already taken out the relative equal highs? Many would look at that as, okay, we took out relative equal highs, we should now go lower. Well, the higher time frame is always going to be parent to the lower time frames. So as I've said, the drawn liquidity was this blue shaded region up here in the on the daily chart. So now that we've established, we've taken out a measure of sell stops. This low should not be violated. Why shouldn't this low be violated? Well, one, because of market structure. So it is now an intermediate term low because we have a short-term low to the left and a short-term low to the right. So that'll classify this as an intermediate term low. So now we have market structure supporting our idea. We have order flow supporting our idea because now discount arrays are supporting price higher. And we are seeing that we have our drawn liquidity and it's continuously gravitating towards it. So I didn't join the party until this movement here. So now let's drop into a 1 minute. Now that we've solidified our higher time frames, daily, 5 minute, we're confident that order flow is bullish. We have a higher time frame objective. Now in my 1 minute is where I look to go in to execute. So as I've said here, rallied higher. We're looking at the same price action now on a 1 minute chart. Price traded down to the discount levels, fair value gap here. And then price then rallies higher from there. So then we see here right at the 3 o'clock hour, price then displaces higher with speed. And I went to enter inside of this bearish order block in here. So here we see this is institutional order flow entry drill. And as I shared in the chat, a gentleman was asking me, what is institutional order flow entry drill? I'll go ahead and recap that real quick. So institutional order flow entry drill, according to ICT, is when there's a fair value gap and price trades down in a BISI, which is a buy side imbalance, sell side inefficiency. It's inefficient in sell side delivery. That's when price just hits the high end once and then immediately rallies off that. What's occurring at this key level? We're seeing that high frequency trading algorithms that are employed by smart money or different traders are hammering buys at these key levels. So it hits it. The market is just spitting out buys from those algorithms. And then we see price trades down into it once more, which is then hammering buys inside of this key level. And then price then rallies higher. So this is actually where I got my long inside of this bullish order block. So these series of down close candles, as price traded into it, I went long. That's another entry technique I have. I have multiple entry models that can get me into a trade. As long as I know where price is going, you best believe I'm going to be in that move. So I have several entry techniques that I've honed over the months and years of just studying different price movements and different entry models. As you guys know, I have my favorite one that I look for that I actually made a recording of on the YouTube, but I do have several to get me into a trade. As long as I know where the market's going, I'm more than likely going to be in that move. So here we have institutional order flow entry drill. As I said, I got long inside the order block. And then as price was trading higher here, and we were still inside of this down close candle, this bearish order block, I went long in here. You could say, well, that's chasing price because now it's moving higher. Well, it's not chasing price because we're still inside the order block. So you're still accumulating inside of a discount array. And then we see here, most people know order blocks as, okay, down close candle displays higher, we trade back into it, now we buy it. You can accumulate longs like smart money would inside of the Dow's close candle. So if you know it's likely to go here, and actually there's a new week opening gap. So let me show you that so I can show the precision elements that went into this trade setup. Okay, so this is a new week opening gap from February 12th to 17th. So this was my draw on liquidity inside of the daily fair value gap. So there was several premium arrays that price would want to deliver to. So that's why this was a high probability setup, not simply, oh, well, there's an inefficiency, it might go there. I'm very confident it's going there because of several reasons. And there was also another, let me show that once more. So there was also another new week opening gap here. And as ICT recently taught, that between two new week opening gaps, the 50% is called the event horizon. So once we deliver through 50% of a new week opening gap, it's high probability to deliver into the next one. So that was further confirmation to expect this new week opening gap to be delivered to. So dropping down into our 1 minute here, I went long inside this order block on this retracement, and then I accumulated more longs inside of this bullish order block for the expansion move higher. So we have the daily fair value gap in blue, we have the new week opening gap in yellow, and I was also able to use fib extensions to give me further confirmation that my target was likely to be delivered. So we also have the negative 2.5 standard deviation at that 41.36 level. So now you guys can start seeing how there's several confluences aligning for why I'm expecting this level to be delivered to. It's not just as simple as, oh, fair value gap, let's buy it and hope it goes up, or new week, or there's a new week opening gap, it might go there. There's several confluences that line up for the precision elements that we employ in price. So I enter here, and then at the 315 to 345 macro, I'll mark that out in purple. And then it carries me on home into the objectives, almost like it's coded to do that. So that's just a quick breakdown on how I use order flow to get into my entries, to determine where the market's going, and to make sure I'm not getting in too early or prematurely. So I have several confluences behind my trade setup, my draw on liquidity, order flow, and I want to see stops taken. Because once you see stops taken, as I mentioned down here, this is a key low. This should not be taken out. Why shouldn't it be taken out? Because it already did the work of running out these stops here. So this low should remain in place if you are to remain bullish. So that was an additional confirmation as to why I was expecting these higher prices here. Hey, Vent, thank you, very informative. Thank you for sharing your time with us, brother. I appreciate it. So what are the macro times of the New York session? So for the AM session, the ones I'm familiar with that I use are the 9:50 to 10:10. There's another one at 10:50 to 11:10. There's a lunch macro. There's a PM session macro in the last hour that I use. But there's also macros really from any hour from the 50 to the 10 minute of the following hourly candle. Why is that? Well, if you think about it logically, the last 10 minutes of a closing candle, like for example, looking at the hourly. Here, let me take this indicator off. So we're not looking at an hourly chart. So each candle is 1 hour in duration. So what's going on in the last 10 minutes of an hourly candle? Well, it's trying to aggressively reach the objectives it wants to reach. And then in the first 10 minutes of the following opening candle, That's typically the accumulation manipulation phase of that candle. So that's typically why price runs originate in the macro. So one key thing to focus on with macros and to keep in mind is that the macro isn't going to deliver to your objectives. It's going to set up the move that's going to deliver. So if you get an entry inside of a macro, don't feel like it needs to deliver inside of that macro, as it can set up the move inside of it and then deliver to the objectives after the macro is finished. So I hope that covers your question there, Vend. Thank you very much. And then let me check the chat real quick, make sure we don't have any questions. Okay. Yep, so that's going to go ahead and conclude this session. Thank you all very much for joining us and spending time here with us. I hope you guys got something out of this, and as always, feedback is greatly appreciated. Be sure to hit that like button if this was beneficial to you. I really appreciate you guys sharing your time here with us, and as always, I'll be updating the Telegram. My associates and my colleagues will also be, and then as you guys can see, we've been focusing much more on the Telegram, giving you guys analysis daily, teaching specific concepts that we implement in our analysis to make sure you guys are abreast and up to date as to everything that's happening in the marketplace that has our attention. So with that being said, I hope everyone has a great rest of your weekend. Thank you very much for sharing your time with us. And with that being said, I'll update everyone in the Telegram. Look forward to speaking with you guys next Sunday. Thank you very much.